Hey guys, so in this lesson we are going to be going over our entry rules, what to be hopping into, what to be on the lookout for, and what you need to see in order to hop into a trade. We will be going over in future lessons stop losses and take profits. We will be going over exit signals as well. We will be going over failed trade and live trades. And if you are part of the Discord group, we will also be going over all of this in a live class. But if you are in that private Discord group, the link is in the description to join it, then you should be absolutely fine, and this is going to be really, really fun. So, first things first, you might be looking at this and saying, oh, this is in April. Alex, in your podcast, don't you call out people that give out perfect examples that are a couple of months ago? I absolutely do. Currently, at the time of recording, it is July. And I've gone all the way back to April to find something. This was just a specific example that was very, very perfect, and what I would love to have this trade happen every single time. And whilst we're at this stage now, it is good just as a learning example. But as I've said previously, we will be going over failed examples, other good examples that might be 2 days ago, a week ago, etc. So please don't get hung up on that it was quite a while ago, because I have brought that out, that it's a very good sign for a scammer to be out here. So I do want to address that before I get into it. However, first things first, in terms of our entry rules, what do we have? We have define consolidation area, right? We want to define it. We want to make sure that we are hopping it into consolidation. And I've basically defined this area by drawing out this box. I'm identifying it, right? Identifying it, defining it, however you want to put it. Now, we know that consolidation is 24 hours of horizontal movement. 24 hours of horizontal movement. What is this characterized by? Realistically, we're going to be looking at no new highs or lows. Right? That is what determines what horizontal movement is. No new highs or lows. What can I see here? Well, is this high realistically higher than this one? Maybe by a pip. So I'm definitely not going to say that, right? That's not it. Is this high higher than these two? Yeah, it is. But is this high? Or is this high over here? No, it's definitely not, right? It's definitely not. And if we're looking at all these bottoms, if you're actually looking at wick structure and you're counting them as bottoms, then you've got a triple, quadruple bottom through here, maybe even quintuple through there. You've definitely got a triple high, and if you're looking at wick structure again, then none of these highs are higher. You've got quadruple high. You could say, Alex, then it starts to go down through here, and then we form maybe a slightly lower one. But again, it's really not forming any new lows and any new highs. It's definitely not doing this, because what constitutes a trend? What constitutes a trend? Well, we are going to be having new highs and new lows. Even if we got new highs here and we're saying, yeah, these are lower highs, Alex, we're not getting any different lower lows. It's not happening. It's not breaking through this area here if you're counting wick structure, and it's definitely not breaking through this area here if you're counting candlestick closes, right? That's not happening. Whereas over here, what can you see? So if this is a low here, here's a high. Yeah, all right. That's a new low. Is that a new high? Not really, but definitely a new low. Is that a new high? No, not really. And then you could go, oh, we don't have a new low. That's where I'd start to be looking at horizontal movement. But of course, then we go up, new high, not new low. New high, new low. New high, new low. New high. Oh, there's no new low. Is that a high? Maybe not. But that's definitely not a new one. New low, definitely not new high. Definitely not new low. Definitely not new high. Definitely not a new low. Same and same and same and same and same and same. That's what that looks like. Even though this one might have consolidated or ranged slightly, I should say, you can see the difference between using this path tool. It is your best friend. It will help you out so much when identifying market structure. Because when you are in a trending market, it is going to, oh, that actually goes down. It's going to look something a little bit more open and free, not stuck together like we can see in these areas. When the market is truly going and trending, you will be able to see that is what it is exactly doing. It moves, not like this. So I might have gone a bit overboard by telling you that, but it's definitely something that is extremely important. So then let's move on to the second rule from here. Defining the range. Defining the range. Now I've put this in small letters because the first thing and the most important thing is definitely define the consolidation area. That's the first thing that we really need. So look at the range. This is just drawing out support and resistance lines, right? But I am not going to be drawing them at the top and the bottom. That is not what I want to do. What I want to run this line through is the area of most resistance and most support. What do I mean by that? Well, if I draw this line out here, let's go over it. And I'm going to draw the line over here as well. Now, as you can see, I've chosen not to include the wicks. Why is that? Because this area is tested so much more than this area down here. Right? If I put it down here, 1, 2, 3, 4, maybe 5, 6 times at most, it would be tested. In here, I've got an area where it bounces off once, twice, 3 times for sure. Closes on realistically this line here, 5, 6, 7, 8, 9. So many more times as it go through here. So I want to find that line, and it's the difference between wick structure and candles closing. Right? I want an area where it closes through the most. If I looked over here, for example, and again, I was to put it down here, okay, that's not so bad. You've got a few areas that it's closing on. But if I just raise this line up just slightly to here, do you see how that line is being tested? It's been rejected off so many more times. And just having it a little bit further down, that is the area that I'm talking about. If I were to have this all the way at the top, great. Maybe I've got 1 there. I've got 3 there. That's great. But if I just bring this down to here, I've got an area where there's a load of support. And 80 to 90% of the candlesticks want to be captured in this area. And that's the whole of the candlesticks. 80 to 90% is captured in this area. And you can see the exact same thing is captured in here. If I'm doing it up here, or if I'm doing it down here, I'm capturing 100%. That's not what I want. I want there to be breakouts because I only want to find the range where it's really just bouncing around in. Hopefully that makes sense. Then I am going to be identifying order blocks or OBs, right? Identifying order blocks or OBs. Now, this is actually quite simple because all we're going to do at this point is basically just draw out the highest parts and the lowest parts. So sometimes order blocks might be around the range area, or they might be down here. This is where, again, we're not looking to go to the lowest point or the highest point. There will be wicks always roughly around the same area that are going to identify where the market is rejecting off. This example over here is slightly better. Maybe the range is in here, but I know that the order block is actually up here. Why? Because why are wicks randomly hitting this area? They burst out of that range. Right? The market always wants to continue to trend. That's what it wants to do. Buyers are either going to win, sellers are going to win. So it wants to go up or it wants to go down. It doesn't want to go sideways. That is not the natural movement of the market. Ranging is. Of course it is. We've got news events that push it up. We've got buyers that push it up. We've got sellers that push it down, news that pushes it down, and everything else in between. Right? We've got all of these things. We know consolidation is the playground of smart money. So some of these areas are going to be artificially created by what we talked about in that Why This Concept Works episode. So if it breaks out and it's wanting to break out, then something around this area here, this blue line, is pushing it down. Not in the range, because that's just bouncing around in here, waiting to break out, accumulating orders. But when it does break out, there's something around here that's pushing it back down. And just like up here, there's probably something somewhere around this area. You could potentially say it's down here, but I think this area is just slightly better. You're close with these ones here. They're all wicking, and when they touch these, they kind of push back up. So I know there's something down here as well, potentially even as far as here because of this area that's pushing that market back up. It's not always going to look the same. So that's what I can see down here. There's an order block down here that's pushing that market back up, and an order block up here that's pushing the market back down. And that's how I define them. So why do we do this? Because inside the range is a big no-go area. It's a big no-go area, right? That's what we are identifying. We're identifying this area so we do not hop in like those silly retail traders that are always losing in this area. We don't want anything to do with it. I don't want to monitor it. I don't want anything to do with it. But once it starts to break out of here, once it starts to break out of these areas, then I can be looking at this, because we know that the order blocks are going to stop fake outs. It can break out here, it can fake it out, but the order block should, in all theory, stop these fake outs. So we want to then, as rule 4, have an order block, right? Break out. That's what we want to have an order block breakout, because we want to break through this range and then break through the order block. That's what we want to do, because if we're testing these order block areas, remember, well, what they can do is if they decide to come down here and they break through this order block, that means they've put in a crap load of orders to the downside to push it down. And this order block, if they get it all the way down to here, or price action comes all the way down here, they've closed it out. Because remember, smart money's not going to really go into negative drawdown. It either is just going to have let all their order block or their buy orders from here, if it does go down, just they're going to close them out either in small profits or break even. And then that's going to allow them, because there's no more buying pressure pushing up the market, to get all these sells in. So what do? Again, they put a sell in, they push the market down, push it down, fake them out, so all these buyers go, oh no, hop in, let's go for a sell, whatever it is, or maybe they're taking out their stop losses, whatever happens there, and wherever this order block is, they'll just take it out. So there's no resistance. So that's what we're looking for here. So if I bring this forward and see what happens, this is a perfect order block breakout. It goes and it closes beneath. So once we've got that breakout, what we want as number 5 is the breakout candlestick to close beneath. It could be above the OB line. Wow, I spelt that incredibly wrong. Beneath. I don't know if it actually has an E on the end. Anyway, beneath / above the order block line. That's what we're going to be looking for. So it breaks through the order block line, have an order block breakout, but the breakout candlestick to close beneath or above the order block line. So of course it was coming up. We want a candlestick to close up above here. But we're not done, because we can't just hop in straight away. That's stupid. Even though it's starting to go down, what we want then as our final rule from here is 6. We want a retest and breakout of previous OB area. Retest and breakout. So what's happening here? This candlestick, or these candlesticks, are coming right up to that area, and look what happens. This is why I say it's perfect. Come straight back over to here and watch what happens from here. We've retested that line, we immediately start falling down. Retest and break out previous area. We retest it, and we just start falling away. Usually I like to either wait for 20 pips. So this is actually quite small here. So I'm either waiting for 20 ticks, which can literally lead us right underneath here, which is going to be perfect, or 2 hours of consecutive movement back away to classify that as another breakout area, right? That's what we'll be looking at. And then we would be going into stop losses and take profits for the next area. And as you can see from this one, it can be quite lucrative, especially when you're hopping into the market. If you applied this to this exact same area, once it broke out, retested through here, you either have that 20 tick move, which you definitely get, or you realistically get something through there. You could have hopped in, stop loss would have been different through here, but you can see again that you have the potential to have a really good move. Now, for different reasons, we will be going into these stop losses and take profits, because as you can see, these areas look quite different from each other. So we do have to go into them. But that is going to be the next lesson, and that is what we're going to be looking over there. Hopefully this makes sense when you go over it. You may need to watch it a few times, or book in a lesson with me, or whatever it is, but we can go over this strategy together. Make sure you pay attention to the next lesson when I bring it out. But thanks guys, that's it from me today. I hope you've had a prosperous trading day. Speak to you later. Bye.